Hi, and welcome to Sunday Night Charts, where we take a look at the charts to help you with a trading week ahead. I'm your host, Steve Van Meter, and this week we are going to talk about volatility. I have been remiss in my responsibility to add volatility to the Sunday Chart Show. Many of you have asked. I have had good intentions to, but I've forgotten, but I will not forget today. So we will look at how volatility is positioned and what is suggesting perhaps for the stock market. No, we're not going to talk about the volatility ETF, but we will look at the VIX. Let's get into this. The trend indicators from my price and momentum. Short term is 9-day, intermediate 21 days, long term 50, ultra long term 100. Looking at the moving averages, these are the colors on my screen. 50-day will be in green, 100-day in blue, and 200-day in tan. Price versus momentum. Price is the general direction prices are headed. Usually very easy to figure out. Momentum is the rate of change of the price. So a bullish indicator for both is positive and a bearish indicator for both is negative. Momentum often, but not always, leads price. Technical analysis attempts to determine where buyers and sellers are at. Resistance is a level buyers can't break, and support is the level sellers can't break, or resistance is where sellers are at and support is where buyers are at. Remember, technical analysis does not predict prices. It can be used to determine the risk of a trade, help with timing a trade, and provide the direction to the path of least resistance. Charting offers possibilities, not probabilities, and not certainties. Should be pretty obvious in the recent market action that that is the case. Let's start out with the S&P 500. Short-term indicators unchanged. Intermediate term unchanged. Long-term is the only one that switched on momentum to bullish. Overall price is bullish across the short, intermediate, long term. Momentum is bullish across the intermediate, long, and ultra long term. Let's take a look at the charts. And this is going to be kind of an indication of what you're going to see in today's show because we had a shortened trading week. Friday, there wasn't a lot of price action, so there wasn't expected to be a lot of change in the positioning, but a little bit. So we have S&P 500 sitting right at its all-time high, not its all-time intraday high, but all-time closing high. And bears are looking for this to reverse really quickly, and the bulls are telling us, hey, the trend is your friend, and the trend is up, and that ought to be good because maybe more people will buy at the top, which is actually when most people buy. Let's go on to the NASDAQ 100. Again, you'll notice not much of a change here. The price action is consistent, bullish across short through long term. No change on the ultra long term momentum. We see intermediate and long term flip to bullish. From a price perspective, we should just see about the same thing, except the NASDAQ is not near it is near its all-time closing high, but it is not at its all-time closing high like the S&P 500. Again, bears are saying, hey, we want this to stop and stop soon. And the bulls are saying, look, all we have to do is push through this seller, where all these sellers were at from a technical perspective, and it looks like we're going to achieve that. Again, trend is your friend. There's a lot of people calling for a massive move higher in stocks. Pretty interesting, I think. Let's go on to the Russell 2000. If you really want to see where people are bullish at, they're bullish on the U.S. economy, bullish on small caps. And I'm not sure their bullishness is warranted, but it shows up in the data. Look at the price, bullish through the short and long term. No real change except for a small bearish switch on the momentum in the short term, which usually isn't a major indicator at this point. Intermediate, long, and ultra long term momentum indicators are bullish. From a price perspective, wow, look at the Russell 2000. It is, I think it's at all-time closing highs. If not, yeah, I think it is. It's at all-time closing highs. People are very bullish on the U.S. economy. And now let's move into, there's really not much to say from a technical perspective. Look, it's up. I mean, there's nowhere to look, nowhere to say, hey, there's resistance or support. It's up. And let's take a look at the VIX. The volatility index is sitting down just over 20. Broke through there on Friday and found some pushback immediately. We can see the 20 has been kind of the lower end of support, at least going back to August. But here's what equity bulls are looking at. See, equity bulls are salivating over the VIX right now. They are seeing that, hey, this thing could easily get back down into the teens which would be super bullish for the S&P, NASDAQ, Dow, which we don't need to cover, and Russell 2000. That's why you see a lot of bullish pressure in this market, is because they're looking at the VIX and saying, look, this thing has not dropped very much, and it could. Of course, it also could go the other direction when the VIX does eventually break through this heavy selling, which it's seen in between the 35 and 40 level. At some point, we're going to see the phrase suppressed volatility leads to hyper volatility. But for the moment, VIX sellers, volatility sellers, are going to look to take volatility lower and equity prices higher. How about the energy sector? I mean, talk about going from bearish to massive bullish. Now all of a sudden, everybody thinks that energy prices are going to go up, 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 and up. And yet we're continuing to hearing about layoffs, and layoffs. And you know what doesn't generate demand? High unemployment, at least not for the energy sector. That's why these big corporations are laying off. No change on the price action. Momentum we do see is kind of interesting. Short term went bearish, long term went bullish. And let's take a look at the XLE, which, as we can imagine, should be up. And it is indeed. Trend obviously back to your friend, and it is finding a little bit of resistance going back to this cluster of selling back in June. So a little bit of selling pressure there. Will this hold up? Will the inventory data? I think that's really the key here, is what about demand? Usually you see increased demand around holiday weeks. So I'm sure this week we'll be looking to find out what kind of demand we saw last week. But with a lot of people on unemployment, a lot of states, bringing back restrictions, will demand persist through December? Hard to say, but it almost doesn't seem likely at this point. But anyways, there you have it. Resistance sitting right at some near-term resistance. Major support is still back around $33 to $34 a share, sitting at 39. Let's go on to the financial sector. And XLF, same, it is the identical story to the energy XLE. We just see a little short-term bearish momentum, a little ultra long-term on bearish price. Let's take a look at XLF, which got bulled up because, again, everybody thinks that vaccines are going to lead to a reopening of the economy. And that's going to mean everybody's going to get their job back, and all the people who wanted jobs are going to get their jobs back who didn't have jobs before the pandemic. And because of all the government transfers and whatnot that's going on, and forbearances on loans, that people have a massive amount of pent-up demand to spend in the economy, and that will drive interest rates higher. However, there's a problem. Interest rates aren't moving higher, and to add to that, the banks are still keeping lending standards super tight, but the market is driving financial stocks up. Now, normally when you see financial stocks rise, what do you expect? Is you should expect interest rates to be shooting higher. Now, let's just put this in reference point. Right now, the XLF is back where it was in the end of February. So when we look at bond prices, what we would expect to see is they should be somewhere at that same point. And we already know that's not the case. But really, where is the next stop for the XLF at this point? Well, it's pretty much right here. You can see from a technical perspective, I'm trying to move the line here, duplicate and drag. You can see it's finding some resistance right back where it did in July, and looks like end of July, end of September. Find a little resistance there. Again, bulls are going to want to see the next major level of resistance way up near $30 a share. We'll see if they can do that. The bond market is not supporting that, which is pretty interesting. Let's go on to utility sector. And now we're starting, the once real hot utility sector is really starting to turn bearish on the short and intermediate term, both in price and momentum. The long-term and ultra-long-term haven't changed, but we notice now we're starting to see some bearish pressure on the utilities. How about industrials, which would look more like the Dow, which is why we don't go over both. No change on price. It's consistently bullish along with the major equity indices, and we see short-term switch on the momentum to bearish. No surprise there. Maybe a little bit of surprise that it's the momentum on the long-term flip to bearish. How about gold miners? Now, some of you pointed out that, hey, when Steve's trend indicators show red, maybe it's time to buy. Maybe that is how you look at this. I don't know. No change in GDX, completely red, no asterisk, meaning nothing changed. Let's go look at what's going on with GDX. And you can see this from a technical perspective. It's pretty ugly. It's under its 200-day moving average, under 50-day, under 100-day. And this bearish flag that bullish flag that everyone was hoping was bullish, and I was not a subscriber to that. It's sitting at the bottom end of that range, almost at the edge of a cliff, looking to fall down, needs to find a lot of support, and there is support here. This is kind of where, if you look at GDX, you can really see there's support right here around 22, and it's sitting at some support at its current price of, say, 34, maybe a little below at 33. And what does that mean? That means there's been prior buyers here. So the question is, are these people that were buyers, are they still buyers? Are they going to come in and buy some more? Is there enough of them to propel gold mining stocks higher? Now, on Friday's show, some people kind of said, well, wait a minute, why did you use GDX as a proxy for gold? Simple, because what happens is the miners usually lead the metals. So most of you tend to trade the actual mining stocks, and you can see here I'll overlay GLD. We could put gold futures, but you can tell the mining stocks tend to lead the metal. Again, most of you, from what I've seen in the comments in the past, are trading the mining stocks, or trading mining stocks but holding metal. So that's why I use that. But anyways, you can see right at some, I would say, pretty important level of support here, because if not, the next level of support for GDX, and there's quite a bit of it, starts showing up between 26 and we'll say 29. If not there, then you're really looking back to the multi-year lows between 18 and 20. Could be a big opportunity if GDX gets back down there for those who are looking to add to those positions, especially when we get to the dollar. If the dollar takes off and you're already seeing gold mining stocks head lower, oof, that's going to be a big, brutal wrecking ball. Emerging markets, no major change there here, except the ultra long term has flipped bearish, but that's not a major issue. What you'd want to see for a trend changes, the short terms and intermediate terms start to flip bearish. So the flip on the ultra long term means almost nothing to me. And you can see that emerging markets are just grinding up. I mean, crazy here to think that emerging markets are back near their all-time highs. I mean, you have to go back to the great financial crisis highs. I mean, otherwise, emerging markets here are kind of telling you this whole goose is cooked on the equity market. This thing is very ripe for a reversal. Let's see if we can drag one of these purple lines up here. And there we go. You can get a real clear picture of just how overextended emerging markets are, and massively, massively ripe for reversal. Let's go on to TLT, everyone's favorite bond fund, TLT. Oh, look at that. We got a little change in momentum to bullish otherwise. So short-term, intermediate term, now bullish across the board. So when you see bullish indicators on both, that usually is a pretty good indicator. The long-term, if you're looking to see a major trend change, now the long-term would want to flip. So that means the 50-day moving average, we would want to see it start to rise. And then, of course, it'll be a while before you start to see a move on the 100-day picture, just because of the massive amount of bearishness on bonds. But remember, from when we looked at XLF, if you go back to July or February lows, so here's where, and I'll zoom that in a little bit so you can see it. Here is where XLF is saying the bond prices should be. So one of these two is wrong. Either XLF is wrong or TLT is wrong. And well, we know pretty much that XLF is wrong, mainly due to the dealer auction bidding that we've been looking at, and the effects of quantitative easing, which are to keep interest rates low or to lower them. And so what you see here is TLT is in this trading zone. It is looking at its 50-day moving average. Bears want to see this be an area of resistance and drive prices back down. Bulls want to see this break up, get over this little dotted orange line, and then start to put some pressure on the 100-day moving average. break over 165 here, super bullish, and break out over 172 when that day eventually comes, will lead to new all-time highs in bond prices and new all-time lows in Treasury yields. How about high yield bonds? No change at all in the picture there. None. No change. Let's go to the price charts and see what's going on with high yield. And we ought to zoom out. And it's pretty much not quite. I think it could get a little bit higher here. Yeah, and I think the high yield space would like to see that. But rates on high yield is super low. If we go over here and look at, where is HYG? The dividend yield's 5%. I mean, that's pretty low for the amount of risk that people are taking in the junk bond space, in my opinion. But you can see, I think it's got potentially a little more upside before it gets into this heavier level of resistance, which would be somewhere right around $87 on HYG. Next up, we've got gold futures. No surprise, totally bearish across the board. We kind of already looked at gold, looked at the GLD, but let's take a look at gold futures and below the 200-day moving average. And for gold, if you're looking for the next level of resistance, it's very obvious because you can see that was a level of resistance before. It broke through and became now a level of support. And so if I had said resistance, I really didn't mean next level of support is at 1750. And so bulls need to get their act together fast. Otherwise, they're going to see a retouch of 1750. And there's a range there between, 16, what do I have there? Roughly 1690 and 1750. A lot of trading going on there. So that's your major area of support for gold miners. Let's take not gold miners, for the metal, gold, geez. How about silver? Now I'm also completely bearish across the board except for the ultra long term on momentum. Let's take a look at silver. We shouldn't really see much of a different picture here. Looking at silver, it is pretty much sitting at support. So those who are bullish on the metal need to get the buyers going real fast, or really the next area for silver. I mean, your next level of support, it's just under 19. I mean, it's sitting right there. You can see 1, 2, 3 bottoms. There usually aren't too many more than 3 bottoms, because at that point the door falls off, or a trap door falls out, price goes down, and it's got a long ways to go. Could be an ominous sign for the metal, for gold, and for the mining stocks, gold mining stocks as well. Oops, there we are. How about the dollar? The dollar bears are celebrating. They were celebrating all last week, and good for them. Maybe they'll get what they want. And that is a weaker dollar, which would, again, help out equity prices. As we know, people have been moving out of their money market accounts and back into the equity markets. So price bearish, momentum nearly bearish across the board. And let's take a look at the dollar as soon as I can get to my screen. Here we go. And what do we see at the dollar? It's sitting right near its prior recent low that everyone said was the end of the dollar, at sitting at 91.78. Its low, recent 6-month low is 91.75. From a technical perspective, let's zoom in here. Everyone thinks the dollar at this point is now headed down to 87, but remember, there's still a little bit of support here, about 25 cents down on the dollar. So it's not over yet. It's been down a little bit lower than this and still rebounded. But as far as a trend and momentum say, bad. But from a fundamental standpoint, it is bullish, actually. I mean, you look at what's coming in December. You have more lockdowns, more businesses closed, more people that are likely to lose their job. I know we got to go over Bitcoin, so I'm just going to talk a little about the dollar for a second. You have the CARES Act money going away. You have the pandemic unemployment insurance going away at the end of December. You have a lot of things that are going, and you have the moratorium on evictions going away. So you have a lot of things that will create demand for dollars as people have less of them. All right, let's go and look at Bitcoin. Because currently there's a couple people, I didn't know anyone that was bearish on Bitcoin, but a couple people in the comments said they were. So I guess there's a couple of you out there, but most people are bullish on Bitcoin. And from a technical perspective, does this pull back the end of the world? No, it is not. If you want to look at this from a technical perspective, because there's honestly, I don't know how you do fundamental analysis on Bitcoin. So I'm sure some of you know, but I don't. You can see it came down and tagged support going all the way back to December of 2017. So you're looking almost 3 years ago. It had to go back and touch that. Is that necessarily bearish for Bitcoin? No. The bulls want to see this hold as support. And since there's only a couple people bearish, maybe they don't really care that much. But if this does not hold, now you're suggested to see Bitcoin come back down into the 13,000 range from here. So, all right, well, that is our Sunday night chart show. I hope you enjoy it. We'll be back on Monday, of course, for the macro show. And I'm your host, Steve Van Meter. Thanks for watching. The content of this video is provided educational information only. It's not intended to provide investment or religious advice. It's not to be construed as a recommendation or solicitation by a security financial instrument or participating in particular trading strategies. Videos prepared by Steve Van Meter. Personal capacity opinions expressed in the video that do not affect the value of financial advising or Steve Van Meter Financial.